Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CARIS Life Sciences Inc. Annual Report. CARIS Life Sciences Inc. offers a diverse range of businesses and services that cater to various needs in the healthcare industry. At its core, the company provides molecular profiling services through two primary solutions. MI Profile, a tissue-based solution for cancer treatment, and CARIS Assure, a blood-based solution for the same purpose. In addition to these services, CARIS Life Sciences also offers pharma research and development services that include laboratory delivery, strategic data analysis, and research support. These services are designed specifically for biopharmaceutical customers who require tailored solutions for their research needs. The company has also ventured into multi-cancer early detection, MCED, through its partnership with Everly Health, Inc., which aims to develop a blood-based screening assay called CARIS Detect. This innovative approach seeks to identify cancer at an early stage, potentially revolutionizing the way cancer is diagnosed and treated. Overall, CARIS Life Sciences has established itself as a leading provider of cutting-edge molecular profiling services and solutions that are transforming the healthcare landscape. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop for CARIS Life Sciences, Inc. The stock price of any publicly traded company can fluctuate due to various market and economic factors. One possible reason for a decline in stock price is poor financial performance, such as declining revenue or increasing losses. This can be caused by a variety of factors, including decreased demand for the company's products or services, increased competition, or failure to innovate and adapt to changing market conditions. Another potential cause of a drop in stock price is regulatory issues or legal problems. If CARIS Life Sciences, Inc. is facing lawsuits, fines, or other penalties related to its business practices, this can negatively impact investor confidence and lead to a decline in stock value. Additionally, changes in the company's leadership or management structure can also contribute to a drop in stock price. This can include departures of key executives, changes in corporate governance, or other internal issues that may raise concerns among investors. Lastly, external market factors such as economic downturns, industry-wide trends, or broader market volatility can also impact the stock price of CARIS Life Sciences, Inc. These factors can be unpredictable and outside of the company's control, but they can still have a significant impact on investor sentiment and stock value. In summary, there are several potential reasons why the stock price of CARIS Life Sciences, Inc. may have dropped in the past year, including poor financial performance, regulatory issues, leadership changes, or external market factors. CARIS Life Sciences, Inc. maintains a market capitalization of $6 billion, broadly in line with the industry peer group. CARIS Life Sciences, Inc. trades at a higher price-to-book ratio of 9.72 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 827% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in a company are multifaceted and influenced by various factors. On one hand, revenue growth is driven by molecular profiling services, which have seen a significant increase of 120.6% in 2024 compared to the previous year. Additionally, pharma research and development services have also contributed to revenue growth, albeit at a slower pace. The company's ability to scale its infrastructure to meet increasing demand for these services has also been a key factor. On the other hand, revenue decline is driven by several factors, including timing of contract execution, reduction in research revenue, and implicit price concessions granted by the company. Changes in historical reimbursement data from third-party payers, hospitals, and patients have also contributed to revenue decline. Furthermore, shifts in customer demand for specific services and adjustments to standalone selling prices based on historical data and market analysis have also impacted revenue. The financial performance of the company is also noteworthy, with net operating loss carryforwards increasing by $11.2 million in 2025 and $67.3 million in 2024. The utilization of these losses may be limited in the event of an ownership change. Overall, understanding the drivers of revenue growth or decline is crucial for making informed decisions about a company's financial performance and future prospects. The net income of the company experienced a significant improvement from a loss of $281.9 million in 2024 to a loss of $68.1 million in 2025. This reduction in losses indicates that the company is moving towards financial stability. However, despite this progress, the cumulative loss over 3 years still remains a concern. The profit margins of the company have been negatively affected by various factors. The uncertainty surrounding significant expenses and potential future costs has contributed to decreased profit margins. Additionally, increased valuation allowances have led to a decrease in profit margins, with $11.2 million and $67.3 million being written off in fiscal years 2025 and 2024 respectively. Furthermore, cost control initiatives by third-party payers have limited revenue and profitability, resulting in decreased profit margins. These factors highlight the challenges faced by the company in maintaining a stable financial position. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the latest figures, the company has achieved a significant milestone in its financial journey by generating positive operating cash flow. This is evident from the reported figure of $200.3 million, which signifies that the company is successfully converting its profits into liquid assets. This achievement is a testament to the company's efficient management and effective operational strategies. The ability to generate positive operating cash flow is crucial for any business, as it enables the company to invest in growth initiatives, pay off debts, and reward shareholders. In this case, the company's positive operating cash flow suggests that it has a solid foundation for future growth and stability. The financial performance of various segments within the company can be identified from the extracted summaries. One segment that performed well is molecular profiling services, which saw a significant increase in revenue from $5.8 million in 2023 to $16.2 million in 2024, followed by a slight decline to $11.4 million in 2025. In contrast, the performance of pharma research and development services cannot be determined due to its inclusion in the overall pharma research and development services revenue, making it difficult to assess its individual financial standing. The company's global reach is evident from the mention of dispersion across multiple geographic regions, indicating that it operates on an international scale. The management of this company is optimistic about its future prospects. They plan to expand their facilities as operations grow, invest in developing new solutions, and increase marketing efforts to drive commercial success and validation studies. The company aims to maintain and expand relationships with biopharma partners to support a growing number of projects. To achieve revenue growth, the company needs to secure broad coverage and adequate reimbursement for its solutions from third-party payers. This will require scaling infrastructure, including investing in equipment, facilities, and labor. While costs are expected to increase initially, they should decrease per clinical case due to economies of scale. The company's strategy is focused on precision medicine and AI-driven solutions in oncology, with a strong emphasis on expanding its molecular profiling services portfolio through collaborations with biopharma companies. Overall, the management is confident that these efforts will drive growth and success for the company. The financial performance of a company can be evaluated through various metrics, including its dividend payout and share buyback activities. In the case of this company, it is clear that they have not distributed any cash dividends to their shareholders. This decision may indicate that the company prefers to retain its earnings for future growth or other strategic purposes. However, the company has engaged in share repurchases, a common practice among publicly traded companies. Specifically, in 2025, the company bought back 1,429,213 shares for $16.6 million. This move can be seen as a way to boost shareholder value by reducing the number of outstanding shares and increasing earnings per share. That concludes the financial summary for CARIS Life Sciences Inc. Feel free to comment below, and I will be happy to answer them when possible.